Yeah, the stream is up. Should I start? Shreya?
Start.
Hey everyone, a very good evening and thank you so much for tuning into our channel today. I'm Aditya, a member of ISTE at NITK Surotkal, and today we have a very special guest, Mr. Sandeep Das, who happens to be a reputed columnist for Economic Times, Fortune, and Business World. He also happens to be an IIM Bangalore alum. He's been a strategy consultant for nearly a decade, and lastly, he's the author of three successful books, the links to which we'll be sharing with you after the stream. Mr. Das often speaks and conducts workshops at many different institutes, including different IITs and IIMs, and today we have the pleasure of hosting him here at NITK. Mr. Das, very nice to have you here. You may begin.
Good evening, everyone. Thank you for the generous introduction. And I'm going to cover this topic of personal finance for millennials. Now, why is this topic important for all of you who are listening onto this channel? About a couple of years back, I was researching for my book, Hacks for Life and Career, and I spoke to about 250 millennials. And one of the biggest pain points that came across through my interaction was that students and young professionals, people like you, had very little idea about personal finance, meaning what are the various instruments to invest in, where should we invest in, what are the mistakes we should not make. And despite having gone to some of the best IIMs in the country, and I have passed out of an IIM, I was fortunate to go to INSEAD. Despite all of that, a lot of me, some of my batchmates came out with very little knowledge of personal finance. And this is a huge area of concern in the education and the corporate system. So this is why this is important. How I plan to run today's session is, one, I'm going to talk about why is personal finance important to you. Now, it might sound commonsensical, but it's far more important than you might think it is. The second part, I'm going to talk about what are the various instruments that are available. So if you're earning a salary, say, of 100 rupees a month for the purpose of discussion, where can you actually allocate that money and how can you save that money? The third I will talk about is in terms of what are the mistakes people make with respect to personal finance. And you'll be amazed that all of us who have nearly 10, 12 years of experience, my juniors, my seniors, we've all made the same set of mistakes, and nearly everybody makes the same set of mistakes. So I'll take you through that. And finally, I will talk about if you are earning a certain salary, say, for the purpose of discussion, 100 rupees a month, where should you actually save that for someone of your stature and at your stage of life? So these are the four key questions I plan to cover. I will speak for about 40 to 45 minutes, and I'm happy to answer as many questions about 15 to 30 minutes after that session. So this is the agenda for today's session. And I'm going to start with my first question in terms of why is personal finance important for you? And it's fairly obvious that the more money you have in the bank, the better you will sleep at night. Why is this important for you is because your generation, to a certain extent, our generation, is not likely to work for very long. Some of us will have entrepreneurial hobbies. Some of us will have creative pursuits. Some of us might want to take sabbaticals. There's something called the FIRE syndrome, financial independence by retiring early. Some of you will embrace that. So the more money you have in the bank, the more you will sleep, the better you will sleep at night. The second thing often is that the earlier you save, there's something called compounding you would have heard of. The earlier you save and the more you save correctly, over a period of time, money multiplies. And with money, often it is not about how much you earn, but how much you save that matters a lot. Like I gave you in my introduction, personal finance becomes important because almost everyone I spoke to during the research of my book root the complete lack of knowledge of personal finance. And the irony is some of them work in investment banks managing literally $1 million desks, but don't know what to do with their own money. And as a result, everybody makes the same set of very expensive mistakes, which you can avoid. So if you want to sleep better at night, if you want to set your career free, and if you want to take more risk later in life, this kind of topic becomes very important for you. Now I'll move to the second question, and this is where I will take you through a certain amount of theory in terms of what are the various instruments that are available. And there are two slides in this. and I'll take you through the certain asset classes. I'm going to make an assumption that you have very little knowledge about this. So I'm going to start from zero. So if you do have some idea, please bear with me, because I'm going to assume that most of you don't know anything when it comes to the various instruments. Now, on this slide, there are two broad instruments, and the way you read this table is there's a list of instruments here. I have given some description. This has been the historical return profile. This is in terms of what is the risk in terms of low, medium, high, and is it relevant for you and someone of at your stage in life. So green means it's highly relevant, yellow means it's medium relevance, and red is something I'm asking you to stay away from. So on this slide, you will see there are two asset classes I'm discussing. One is debt. The first three lines are debt. The last four lines are equity or mutual fund. So debt, for instance, all of you will know is basically you take money from someone. It's a loan. And because you're taking a loan, you pay back an interest. In simple English, that's how debt works. So in terms of debt, and I'm going to cover the first three lines now, there are three types of debts. So first is debt, which is largely risk-free, meaning that if you put your money here, you will get a fixed set of return, and there is very limited risk attached to it. So what are the various instruments? So one is the easiest one, which is fixed deposits. You can put an FD in a bank. Typically, you get about 5 to 6% pre-tax. You pay full tax on this. The next thing are set as something called a Provident Fund. As some of you will get into work, you will realize that 12% of your salary basic pay you can put into a PF. The company puts another 12% of that into PF. You make about 8.5% without any tax. One of the best instruments available in India right now to invest your money, but it's capped at 12% of your basic pay. The next instrument is VPF, which is Voluntary Provident Fund, which is the same as Provident Fund, but there is no cap. Potentially, you can put a lot more than 12% in this. Again, return is about 8.5%, and you don't pay any tax. So PF, VPF, some of the best quality instruments you have for saving in a debt perspective. PPF, Public Provident Fund, typically is again backed by the government. You're currently getting 7.1%. It is tax-free with a lock-in of 15 years. Again, a very good instrument. You can invest up to $1.5 lakh every year. Then you have something called pension schemes. You can take the debt-oriented pension schemes, which you save for your retirement. There are certain FDs which are given by the post office. Instead of the bank, it is the post office, and it is backed by the government of India. Typically, you get between 7 to 7.5% with a 3-year, 5-year lock-in, but you have to pay full tax on it. There are certain bonds which are given by the RBI. These typically are 5 to 7-year lock-in bonds, around 7.5%, but you pay full tax on it. So these are the risk-free instruments. They are risk-free because they are largely backed by the government of India. And hence, there is very little chance of default from any of these instruments. So if you see the historical return profile, for a lot of them, the return profile is between 5 to 6%. FD, post office, RBI bonds after tax. PF and VPF is 8.5%, and they do not have to pay tax on that. So some of these instruments are highly, highly relevant for you. There is no asset class in India which can give you 8.5% post-tax guaranteed, backed by the government of India. So a PF, VPF, PPF, all of these are excellent saving instruments. I'm moving on to line 2, which is quality debt. Now, one of the issues with the risk-free debt is if you are in the highest income slab, and a lot of you will get into that once you start working, you have to pay 30% tax. So for instance, if a fixed deposit in a bank like State Bank of India is giving you 5.5%, you'll have to pay 30% tax on that, which is nearly you make just 4%. The inflation in India is about 5-6%. So you're actually not even making up inflation. There is something called quality debt that comes in, and this gives you a slightly higher return with better tax treatment, but only incremental risk. So there's something called two asset classes. One is called corporate AAA bonds. Now, these are essentially a fund house, a mutual fund house like, say, HDFC, will buy bond paper of AAA companies. AAA meaning highest rated companies like RIL, Infosys, TCS, the best quality of paper. So it will basically buy the loan paper of these companies. And because they are AAA, there is very little chance of default. The second kind of asset class with quality debt is PSU banks, public sector banks like State Bank of India, Canara Bank, etc. And you can buy the paper, or you can get a mutual fund house and you can buy papers of PSU banks. The reason people look at PSU banks is because they have a government backing behind that. A State Bank of India is by default backed by the government of India. The return profile is typically 6.5 to 7%, but the benefit comes in is with taxation. If you are in the highest income slab, you don't pay 30%, you pay something called as 20% minus indexation, which roughly translates to 10%. The risk profile is also low because AAA means some of the best companies, the biggest companies in India, and PSU banks have by default the backing of the government of India. So from a relevance point of view, for some of you looking to invest in quality debt, this is extremely relevant for you. I'm moving to the third line, which is risky debt. Now, risky debt meaning these instruments can theoretically give you a lot of return, but they carry a massive amount of risk. So for instance, there's something called credit risk bonds. Basically credit risk bonds meaning there are mutual fund houses that buy loan paper of companies which have a risk of defaulting on their payment, but are going to give you a significantly higher return. For some of you who follow the news, you will see that Franklin Templeton had to shut down some of its mutual funds. It was in this category. Similarly, there are dynamic bond funds, meaning that bond prices, and these are the slightly technical, bond prices are directly or inversely related to interest rates. And here the fund manager is taking a call on the future direction of the interest rate. So for some of you who will get into advanced finance, you will understand what I'm referring to. The return profile of these two assets have ranged between -5, because in case of credit risk, there was a default, to about 8%. The risk is extremely high and strongly suggests that you don't get into it. So these three instruments are debt instruments. Now I'm moving to the equity instruments. And just to start with basics, equity instrument, you can be a single shareholder. Say, for example, a person like me can open a demat account, demat meaning dematerialized, which means it's paperless form. And I can buy one share of Unilever, one share of Tata Consultancy Services, one share of Infosys. So those are individual shares. Or you can have a mutual fund house like HDFC or ICICI, and they can buy shares of 20, 30 companies at one go, so that they are diversifying the risk in a way. And that's a mutual fund. Now, the mutual funds essentially operate in blocks. So one category of mutual funds typically is the large cap, which meaning an HDFC, ICICI, the fund house invests in the BSE top 30 or the Nifty top 50 companies like Infosys, Reliance, HDFC Bank, TCS, etc. There's another asset class which invests in the American stock markets, say the NASDAQ, NYSE, or the S&P. Then there are other kind of mutual funds which invest in mid-cap funds. That means if you put the companies in descending order of size or market capitalization, as we call it, it is between companies ranked 100 to 250 is mid-cap, and below 250 is nothing but small cap. So I'm going to cover the three mutual fund lines now. So the large cap mutual fund essentially is a fund house investing in really large companies, say the top 30 or the top 50 companies by market capitalization. And historically, this asset class has returned what the nominal GDP of the country is. Now, what you read in the newspaper is nothing but the real GDP. When you say India's GDP before COVID was 4 to 5%, that was nothing but the real GDP. That doesn't factor in inflation. So if you add an inflation of 3 to 4%, the nominal GDP is about, say, 8 to 10%. And that is what typically large cap funds return, because they are reflective of the overall country. Now, in terms of risk profile, this asset class is medium risk because it largely reflects the GDP of India, which has been on a consistent trend except the last year. So if you want to invest in mutual funds, you should consider this asset class. The next asset class is something which is the American stock market. And this is basically investing in the international markets. Now, this has been the best performing asset class over the last decade, giving you a return of 12 to 15%. Now, why is that? Because the American stock market has fundamentally done very well because the US has stayed a very strong economy, and the stock market has been dominated by the four big tech players, Amazon, Facebook, Apple, and Microsoft, and all have done very well over the last 4 years. So why does it make sense to invest in an international stock market like the American stock market? Is because the Indian stock market and the American stock market is not fully correlated. And in fact, the correlation is only 40%. It's not 100%. And secondly, you get a chance to invest in some of the world's biggest companies. And there's something called currency gain. So, for instance, if you are invested in dollars, the rupee is going to depreciate over a period of time. In 2009, the rupee was 40 rupees. $1 was 40 rupees. Today, $1 is 75 rupees. Over a period of time, $1 will become 100 rupees. So, if you are investing in the foreign stock markets, you get the currency benefit, you get to invest in some of the world's biggest companies, and you are diversifying your risk. So this is something for people who are interested in the equity markets. I would strongly suggest this. Then there are small cap and mid cap. These are highly volatile. You should never invest on your own. I would strongly suggest you stay away from it because a lot of them have issues with governance in terms of reporting numbers. A lot of them you need to have very specific idea of the market. And it's strongly suggested you get in because whenever there is a down market, so the share market starts crashing, these are the asset classes that take a plunge in the first place. Then there's equity instruments. This is where you can open a demat account and buy one share of Unilever, buy one share of, say, HDFC. And if you see in the period of COVID, the number of equity instruments, the number of demat accounts has shot up from 1 crore to 5 crore. So everybody is online and everybody is doing day trading, everybody is doing options trading. My personal view is that it is best to leave it to the experts because as a retail investor, you can rarely make money from day trades, forex trades, currency trades. You need a lot of information and a lot of time. And it's hence best suggested that you stay off it and let the fund house actually take care of it. So these are two asset classes, debt and equity, which we're looking at. Now I will move on to the next set of asset classes and we look at gold, which you would have heard a lot in your household. I will refer to insurance. I will look at real estate and then some of the other more exotic instruments. So in terms of gold, as you would have seen, gold has had the mother of all rallies. It's up, I think, 30% last year. So how does gold work? Gold essentially works is when there is panic in the world or when people are scared, like they were scared last year, everybody runs to gold. Hence, it is an excellent diversification vehicle. When people are scared, they buy gold. So how do you buy gold? One way to buy gold is to buy jewelry, which historically some of your mothers or sisters or grandparents would have done. Now, that's a very bad idea to buy actual jewelry for gold because the gold companies charge you wastage. Wastage meaning 15 to 20% of that is wasted. And you need to actually keep the gold in a safe place. The second way you can buy gold is through gold biscuits. Now, you don't have wastage in gold biscuits, but the issue with gold biscuits is you still have to keep it in a safe place, whether it's your home almirah or whether it's your bank locker. Again, there's a maintenance charge. The third way to buy gold is through digitally. So there are sovereign gold bonds, which the government gives, or you can buy through a mutual fund house, an HDFC Bank or an ICICI. So you can buy gold that way and they manage it and you only have to manage the online form. You don't have to get into gold. So should you buy gold? And from a diversification perspective, about 5 to 10% of your portfolio can stay in gold if you really want to diversify your portfolio. The next thing is in terms of insurance. And insurance essentially works that I say insurance are multiple types. It can be medical insurance, it can be life insurance. So life insurance is that I will go to the insurance company, say like ICICI Prudential Life Insurance, and I will tell them that every year I'm going to pay a premium. Say for 30 years, I will pay you this premium. In that 30 years, say something unfortunate happens to me and I pass away, my dependents will get a much bigger lump sum because I've taken insurance from you. So why does insurance work out? Because it's something you would have studied. I think it's called the law of large numbers, that the insurance company is dealing with a lot of people who are subscribing to its plans, but the actual event is only happening to a fraction. So the entire money they collect, they can actually pass it on to the fraction of people. Now, there are various types of insurance. One is medical insurance. Medical insurance, especially in this environment, is very critical. So do you need to look at medical insurance? And the answer is it depends. So for your own self, it is unlikely you need medical insurance because if you're going to join a workplace, say in IT or consulting, the company will give you medical insurance. But you should always ensure that your dependents at home, your parents, your grandparents, your siblings, all of them have some form of medical insurance. The second thing is life insurance and term insurance. So term insurance is insurance for a specific term in number of years, so 10 years, 20 years, 30 years. So do you need that? The answer is, if you are the primary breadwinner in a family and people are dependent on you, then you actually need life and term insurance. If you are not the primary breadwinner and you say your family is comfortable or someone else is the primary breadwinner, then you can avoid looking at this. Now, coming to real estate, and essentially there are two types of real estate. One is commercial real estate, which is think of it in terms of your offices, the call centers, the warehouses from which Amazon delivers. And then there is residential real estate, the flats where you typically stay in, the new constructions that are happening. Now, commercial real estate, you cannot directly invest in. So you can only invest through a real estate investment trust. So something like, if you've heard of Embassy, for some of you from Bangalore, Embassy is a very big builder in the commercial real estate space. They have floated this REIT and you can buy shares of that. It's been floated for a year. Should you invest in commercial real estate? So over the last 5-6 years, commercial real estate has done actually very well, grown at about 12 to 15% over the last 5 years. However, going forward, people are a little unclear about how this asset class will do. One, because work from home is going to pick up, but people are also saying that e-commerce is going to boom. So warehouses will pick up. Also, you have to maintain social distancing in offices. So the chair spaces between chairs will go up. So maybe the real estate space will not go down. So people are not sure about how this asset class will move. So it's best to stay away from it. Then comes residential real estate. Now, when it comes to residential real estate, the advice is always that if you're looking to stay for yourself, you should buy it. If you're looking for an investment, it's actually a very poor asset class. So why is it poor for investment? One, because residential real estate involves a large ticket size. If you're in a city like Bangalore, it's about 1 crore, crore and a half. If you're in Bombay, it's about 2.5, 3 crores. It's a lot of ticket size. It's illiquid. So tomorrow, if you need money, you will not be able to sell your flat. And as flats get older, they get more and more difficult to sell and the rate doesn't appreciate that much. The third issue with residential real estate is something called yield. The yield you get from residential real estate is very poor in India. So let me give you an example. If some of you who come from Mumbai, and if you have a flat in Andheri, and a flat in Andheri in Mumbai costs about 3 crores. Now the monthly rent you can get from that is about, say, 50,000 rupees. Now 50,000 into 12 is 6 lakhs. 6 lakhs by 3 crores is 2%. So the asset is only earning 2% monetarily every year. Now, which is very poor because inflation itself is 4 to 5%. Now in the West, if you go to the Bay Area, if you go to New York, the yield is actually much higher, 5 to 6%. But in India, the yield is very poor. Hence, residential real estate doesn't make sense. So for you, what you have to see is, do immediate relatives in your family need a place? Say your parents, grandparents, siblings, do they need a flat? Only then you should invest in it. If your immediate family is comfortable, then you can stay off it because some of you will be mobile in the next 3 years. You'll work at different cities. Some of you will go for your masters. You'll go outside to study. So the next 7-8 years, none of you are really going to buy a flat. So you can stay off it. The next thing is in terms of having an emergency fund. An emergency fund essentially is like a piggy bank. So have about 3 to 6 months working experience in terms of working expenditures parked away in a short-term FD, so that if something goes wrong, say you fall sick, say there is a job furlough, say someone in the family, some mishap happens, this is something you can pool into at very short notice. The next thing I want to talk about is some of these exotic instruments. One is Bitcoins, and I'm sure a lot of you are well read about Bitcoins. Now, with Bitcoins, you will always hear this story that in 2009 or 2010, when Bitcoins were just starting off, someone invested 1 lakh rupees into it, and today he has a massive bungalow in Pali Hill. You will hear the story, but these stories are not true. Bitcoins have had some unbelievable run. They went to $20,000, then they crashed. Now I think they're close to $28,000, and they're slowly getting recognized. There are issues with passwords. It's not fully legalized. In my view, you should stay away from it unless the Reserve Bank fully recognizes it, unless all the central banks, the major banks like HDFC, ICICI, figure out how to crack it. Facebook was planning to do something with Libra. Once Facebook cracks how to do, only then you should look at it. The final thing is in terms of what Berkshire Hathaway, Warren Buffett called as weapons of mass destruction is stay away from financial derivatives. It's very exotic when you're in college, but you will only lose money when it comes to tracking intraday transactions. So these are the various assets that are available, and I'm happy to take questions on this when we come towards the end. I'm moving to the third part in terms of what are the investment mistakes almost everybody makes. And this is basis experience. And I'm sure most of you will end up making this because all of us were told when we were young about this. We all made this. So I'm going to read from left to right. The left-hand side is the lifestyle errors and the right-hand side is the investing errors. Now, in terms of lifestyle errors, once you start coming into the workplace and all of you will get very good jobs of 10 lakh, 15 lakh, 20 lakh, 30 lakh, all of you will get very good jobs. And this huge addiction that will be there because you'll get 3 credit cards a month, the latest iPhone will be there, and a credit card company will come and say, why don't you buy the latest iPhone or the Hermes bag on EMI, and it's only 2% interest. And that's a huge mistake. You should never do that because one, the interest rates are massive. It's 2% a month means 24% a year. And that starts a very bad vicious cycle where you start living on borrowed money. The second thing is often when youngsters start, and we made the same mistake, assume that the job is permanent and hence, the next month's salary will come, the next month's salary will come. It's never that way. The kind of careers you are going to get in, the kind of careers we are in, no job is actually permanent. The third is in terms of spending first and then saving. So this is a mistake I used to do a lot. So when I started immediately earning from my earning after IIM, I would buy whatever I wanted to buy, and the remaining amount is what I would like to save. And I think that's not correct. And not having a piggy bank or an emergency fund is again a big risk. On the right hand side, that is Ileana T. Cruz, for some of you who might be wondering. Personal finance is not meant to be sexy. So if anybody at a dinner table comes and tells you, dude, I found this penny stock, it is going to grow 10x in 10 years, and I'm going to put a lot of money and stay away from that guy. The more boring personal finance gets, the more money you will actually make. It is not a poker table. It is not meant to look sexy. And the more boring you keep it, the more money you'll make. Also, investing in instruments which you don't understand. So I remember when we were young, there would be these complex insurance products which sounded very intelligent, but we never understood how they worked. And often because you think it is so complicated and so much maths is there that I must be the stupid guy and it must be very good. If you don't understand, that means the instrument is not going to make money, and hence you should stay away from it. So these are some of the mistakes, and I will actually answer in terms of what should be the ideal portfolio allocation for someone like you, someone say who's between 19 to 21 years old, looking to enter the job market in a year or two. Some of you might go for education straight away. Most of you will go to the work. So in terms of mistakes, all of you should avoid living on credit card money, like I explained. And whatever money you get, whatever salary you get, say 100 rupees or 10 lakhs, 15 lakhs, 20 lakhs, you should first save and then spend the rest. So ideally target a number like whatever you get. Say if you get 80,000 a month salary, save 50% of it, save 40,000 and then spend the rest. Now, for the amount you're saving, the kind of portfolio I would strongly suggest is as follows, that if your monthly expense with rent and everything will be about 20 to 25,000, you should have about a lakh and a half in an emergency fund, meaning a bank fixed deposit. So that if something goes wrong, you have something which you can tap overnight. Real estate, like I mentioned, never buy real estate for investing at this stage, not for the next 10 years in your life, unless someone in your family, parents, grandparents, siblings need to stay in it. Insurance also, you personally don't need insurance for yourself if you're working. What you need to ensure is your family insurance is taken care of. So say your monthly salary is 80,000 and you are saving 40,000. How should you split that? In my view, 5 to 10% of it should be in gold so that you're diversifying it. How do you save and invest in gold? There are gold bond funds. You go online, you can easily buy them. Debt should at least be 50%. So if you're saving 40,000, it should be at least 20% of, at least 20,000 should be in debt. And when I say debt, about the risk-free, if you remember, the risk-free instrument should be about 30% of that. and quality debt, which is the corporate AAA bonds and the PSU bonds, should be about 20%. The final 20 to 30% can be in equity for some of your interested in the markets. So you can look at two asset classes. One is the large cap funds, which reflect the GDP of a country. And second is the international markets and primarily the American stock markets. So if you are saving 40,000 a month, about of the 40,000, 5 to 10% in gold, 50 to 60% in debt, and 20 to 30% in equity portfolio. That's the kind of saving what you can essentially look at. So this is the fourth question which I was going to address, and I will answer a lot of questions. But if you want to reach out to me, I'm very active on social media. You can reach out to me on LinkedIn, YouTube, Instagram, and Twitter. If you want to bounce something off, please feel free to do it. I have just released a book, Hacks for Life and Career: A Millennial's Guide to Making It Big. It is a lot of what I spoke about is mentioned in the book. The book also has other sections on entrepreneurship, on how to get into a business school, whether you should do the Indian MBA, the international MBA, a lot of business school topics which you should know about. It talks about careers in FMCG, management consulting, e-commerce, and how you can prepare yourself to get there. So do check it out. It was number one on Amazon Hot Releases. It was number 2 in the Amazon Business Bestseller. It's been featured by Fortune, Deccan Herald, and Pioneer. So please do check it out. And this is what I had to speak today, and I'm happy to take as many questions right now.
Thank you so much for that wonderful presentation. It was very informative and very insightful. So we do have a bunch of questions here, and I'll go ahead. So the first question we have is, can you explain the mechanism on which provident funds work, and why is there a cap on just 7 to 8%?
Yeah. So see, Provident Fund essentially is meant to be a retirement vehicle in terms of you save a certain money and which you can access post-retirement. So why is it that it's only 8.5%? It's decided actually by the government of India. And they look at, the reason they can't lower it for the other fixed instruments, which are the PPF, they keep lowering it. They look at something called the interest rate and they keep adjusting to it. With the Provident Fund, they cannot change. The government of India cannot change because there is a whole labor union that is there and crores of people in that labor union. So that is why the government gives 8.5%. It's significantly higher than what the bond rates are. So that's how it typically works. It is meant to be a retirement saving instrument.
All right. Okay. Moving on, we have another question. This is a question I had myself too, actually. If large cap stocks are reflective of overall macroeconomic growth in terms of GDP, then how does the American stock market end up giving higher returns than Indian stock market? Because if I'm not wrong, India's GDP grows at a higher rate than the US does.
Excellent question. It's a very good question, and let me explain why. One is there is something called currency gain. So for instance, if you are investing in the American stock market, you are investing in dollars. And whereas when you encash it, it will be later in rupees. So say in 2009, if you were to invest, 40 rupees made $1. Today, 75 rupees makes $1. So that entire doubling of the dollar strength is something you are encashing on. The second point is, and this is again a very good question, in the American case, what happens is the big four really dominate. The big four meaning Facebook, Amazon, Apple, and Microsoft really dominate the index. And hence they tend to give disproportionate returns compared to what the GDP does. And why do they dominate is because you have to understand in the US, the debt funds don't give anything. The savings interest is 1%. The debt funds at best give 2%. So what happens is everybody puts their money into the equity markets, and hence the equity markets anyway start overflowing, and hence the prices start shooting up. So that is why that market dominates so much.
Just one more question on this topic. The 1 to 2% return rate that you mentioned on debt in the US, is it inclusive of inflation or just the...
No, absolutely. The inflation in the US is very low. I mean, it's, I think, 1.5% itself. But what I told you is the absolute number, not the relative number.
Okay, all right. So the next question one of our viewers had is, can you tell us about capital gains tax that one would incur when investing in the American stock market?
Yes. So, what happens is, if you're looking at the American stock market, if you go through the mutual fund route, I think the taxation in the short run is at your tax rate, and in the long run, which is after 1 year, is at 15%. If you go through the mutual fund route, and I think if you invest directly, there is a way you can invest directly. I don't know if my memory serves me right, but I think it's again in that 15 to 20% bracket.
Okay. Another question one of our viewers had is, you kept mentioning the term financial derivatives. So can you explain what exactly you mean by financial derivatives?
So the best way to learn this is please watch the movie Wall Street, Charlie Sheen and Michael Douglas, or watch The Big Short, which is Christian Bale, or watch The Wolf of Wall Street. So there's a whole. If some of you who will go into business school will learn derivatives as a course, it basically in simple English means you have an asset, could be a debt, could be an instrument, and you are deriving an instrument from that asset. Think of it as calculus in a way. You're deriving an instrument, and somebody is telling you, somebody is taking a punt on the direction, and you are taking a punt on the other direction. So it's some form of insurance you're looking at. So there are derivatives in terms of options, futures, contracts. It's a fairly complex, but in simple English, there is an asset. You're deriving an instrument from that asset, and one person is taking a punt in one direction, and you are basically taking a punt in the other direction, in simple English.
So basically that would mean it's a game of speculation or something?
Yeah, it's not speculation, because you have your line of reasoning in terms of why an instrument. So if you take an option, if you believe, you take a call option today, you can take a Nifty 50 call option. You might believe that, oh, the market is going to go up in the next 20 days, and you might want to cash in that gain in some way. Someone else might believe, no, the market has gone up enough, it is not going to go, it is going to reduce. So hence, both of you will be on the other side of the table in a transaction.
Okay. I believe that was as simple as you could get without overcomplicating it too much.
Yeah.
Um, you had also talked about cryptocurrency, and
Yep.
recently China started experiments with a purely digital currency, no peso
Yeah.
backing.
Yeah.
So do you think that's a precedent for the legitimization of crypto and digital currencies in the near future?
See, I think it's a very complex topic, because Facebook had thought of Libra. They thought of something earlier last year that didn't work out. They're coming with, I think, another version. Some governments, I think, have accepted it. I think Switzerland has, if I'm not mistaken. I think from an investment point of view, unless your central bank accepts it and can control it, see, ideally, all currency should be controlled by the central bank. You should stay away from it. So, even one is recognition, and second is control. The central bank should control all the currency flow, because who's going to enforce it? Today, it's a digital currency. Who's going to enforce it? How is it owned? What happens? I know there's a lot of stories going around. People lose digital wallet passwords, and the currency goes haywire. So unless your central bank controls it, you should stay away from it. The other thing you should look at with digital currencies like crypto is, it is while they say that you need to mine the coin to produce a certain value, but essentially there is no underlying asset. So for instance, if you buy a Unilever share, the Unilever company is making more and more money. That is why the share is going up. If you're buying a debt instrument, somebody is paying you interest, and that is why the value is going up. This is an underlying asset which, in a way, is not generating anything. So you should stay off it unless the central bank, which is the Reserve Bank of India, starts controlling it.
Okay. We have quite a few more questions here.
Yeah.
One of our viewers asked, what if someone has no savings at the age of 28? Would you still recommend having the same saving split that you just suggested?
Absolutely. Absolutely. And if you do not have savings at the age of 28, the debt percentage should be much higher, because at 28, then you need to look at safety. So what I recommended is debt at 50% of your savings. That should probably be 65%. And also, you should not be in a situation where you're not saving anything at 28. The only situation I can think of is you saved 3-4 years after, say, engineering, you went for an international MBA and all your savings were wiped out. That's the only situation I can think of. But you should never be in a situation at the age of 28 that you're not with any savings.
Okay, and what do you think about options trading? Futures and options. A lot of people say that they're much better than investing in traditional stocks.
It's the same thing. It's under the same gamut of derivatives, futures, forwards, options, call put, all of that. See, the thing is, you should always realize that one, it will take a disproportionate amount of time. You are a retail investor, which who has limited resources to do research. You only have Google, you have a few friends to talk to. Institutions are the ones who will make money from it. Think of a trading desk of, say, a Goldman Sachs, and they'll have bulk of research, people doing only this the whole day. Over a period of time, what I have seen with retail investors is they do not make money on options, forwards, and futures individually. They often end up losing money over a period of time, and the amount of time and the bandwidth and the investment it takes, it's generally not worth it for a retail investor.
Uh-huh. Okay. So it's too much work.
It's too much work, and you rarely see the benefit.
All right. So one more question from a viewer. So 50% of savings should be invested in debt, which is risk-free. So VPF is supposedly the best option for it. And is the money you invest in VPF very liquid? And is the VPF investment worth it?
Yeah, so that's a good question. So there are many instruments that are risk free. So it's PF, PPF, VPF, post office, all of that. VPF is one instrument. It is not liquid in a way that you can tap it at any point of time. There are conditions. So, for instance, in certain situations, you can pull the money out. So, one, if you don't have a job for, I think, a couple of months, you can pull that money out. Or I think for your wedding or buying a flat. So, there are specific situations that are mentioned where you can start pulling that month out, but it is not as liquid as, say, a bank FD account or an ATM where you just go insert a card and pull it out.
Okay. Also, one question I had personally.
Yeah.
As a retail investor, do you think it's a good idea for you to invest in renewable and alternative energy companies in the present day?
To be honest with you, I have never been a fan of thematic funds. This is one example of a theme you're giving me. 5 years ago, pharma was another theme. There's another theme you will hear of something called ESG, environmental, societal, and governance. There's another theme. So these are various themes that you'll hear a Make in India infrastructure theme. Because you are basically putting all your eggs in one basket. The way I strongly suggest is you buy a generic large cap fund, let the fund house and the fund manager do all the research. If he genuinely believes that clean energy, alternate energy is going to be profitable in the future and the shares will go up, he will invest in it. I don't think it's a good idea if you take that punt. Let him take the punt. He has far more resources in terms of people, money to take a judicious call.
Okay, so that will be all of the questions for today. Thank you so much for giving us the pleasure of hosting you, Mr. Sandeep. And I hope that every one of our viewers has found this session very insightful. We will be sharing the links to some of Sandeep's books very soon. So make sure you don't miss those. And as always, thank you so much for tuning in, guys. We'll be done for today.
Thank you so much. And thank you for the invite. I hope people found it useful.
I'm sure they did. Thank you.
Yeah. Thanks a lot. All right. Just wanted to understand